Hello everyone, Clifford Bennett, Chief Economist at Treasury Securities. Hope you've been having an interesting week. If you're involved in markets, I'm sure you have. Certainly, and confirmed by various indicators from Goldman Sachs and other people, quantifiably, but in my gut, I already knew it, the most contentious and volatile markets I've seen in the past 38 years. Now that I do think we're coming through the storm though. But is it any wonder markets have been this volatile given what's happening in the world? Russia advancing in Ukraine, fighter jets coming in colliding with US drones, the tensions there building in the Asian region, unfortunately. And then we've got this sort of constant flow of isolated cases and specific circumstances, bank crises. Okay, so SVB, Signature Bank, Credit Suisse, now First Republic in the US is getting something like $30 or $40 billion to keep going from other bankers using the new Federal Reserve FDIC Treasury program, which is designed to look after their friends. Yes, digging a little deeper, Janet Yellen, as I said, Congress was going to be a little bit questioning about all of this regarding the SVB rescue and the new rescue package, that program that's now in place. So Janet Yellen was questioned last night on the Hill, and her responses were, in essence, this, that no, not all deposits for all banks are guaranteed. No, there's still a $250,000 limit. Unless she individually, in consultation with the Federal Reserve and the FDIC, decides that a bank represents systemic risk and therefore the program will apply and all those depositors will get to keep all their money. Isn't it interesting how this is so far applied to Signature Bank, with a lot of powerful depositors, and with SVB, which had the bulk of all the wealth of many of the Silicon Valley elite. So let's keep social media on side and make sure all our friends in the tech industry who are billionaires or whatever manage to hold on to all of their funds. So let's rescue that bank with a taxpayer backstop. But no, I want to emphasize, she said last night, that it does not apply to all banks, all deposits, only if she thinks it's a systemic risk, which is why she used that wording when she announced that rescue program. Now, if you look at a map of the United States, and there's been some interesting research done on this, most banks, it's about, on average for the United States, it's about 10% of depositors have over $250,000. But in California and New York, it's about 66% of banks have depositors that have deposits where depositors over $250,000 represent about 62/3 of their total deposits. So in other words, this is a program to look after Californian and New York banks to be backstopped by the entire population of the United States taxpayers. And it is a taxpayer backstop because there's encouragements to take various other aspects, Treasury, to rip the banks. So if a bank's in a crisis, the government's going to rip out all the best assets and just leave the thing totally collapsed and use those to pay depositors. So that's the upside for some depositors, a very small proportion of American depositors. And for everyone else, it's the same old rules and probably less generously so, given that so much energy will be going on protecting Californian and New York banks. Interesting politics behind all of this. Now, over in Switzerland, the Swiss have put in 50 billion Swiss francs to Credit Suisse to keep it solvent and operating. Signature Bank has been wiped out. Well, has been let go under the new program. First Republic in the US is receiving $45 billion in emergency funding from other banks under this program that Janet Yellen introduced. Do you get to see the clubby nature of this new program? So these banks are in serious diabolical trouble. They're about to totally crash and wipe out, all of these ones. And First Republic was really hidden from the press until the rescue package from the other banks was organized, again, personally led by Janet Yellen. And apparently, Fed Chair knew about the SVB crisis, and so did Janet Yellen, at least a week or 2 weeks before, but didn't make it public. So there's a lot going on that isn't the typical laissez-faire capitalist economic system, or was typical of the United States of old. And I use old in a generous way, in a positive way. The outlook now is a situation where this is not a rescue all depositors, all banks program by any stretch of the imagination. It's almost like a personal fiefdom program of the head of Treasury, the Secretary of Treasury, Janet Yellen at the moment, which is a really odd kind of state intervention system, very selective in its application. This is going to weigh on people's minds. And what it means is a regional bank contagion may actually still be on the cards. So don't rule that out in the US, and don't rule out further problems in Europe. Remember, a lot of these stories are hitting the headlines, and we're all becoming aware of them very late in the game. And it's almost like 4 hours in trading markets now is a very long time in which, you look ahead, any 4-hour period you look ahead, there could be another bank crisis. There is a systemic banking crisis sweeping the world. There is no doubt about this. And I think one of the reasons is how all these mainstream institutions finally, after years, adopted cryptos and crypto companies and products and joint ventures, etc., as valid asset classes. And I think this is one of the things that's undoing their balance sheets. Also, what's undoing their balance sheets is falling bond prices, because they buy bonds as their asset to lend against in a multiple, and then the value of the bond falls, and then they're in trouble. So we've had this recent bond price rally on the back of the crisis, but that rally, I think, is probably over. And personally, I'm going short US bonds at the moment, the 10-year. So I do think there is risk of bond prices falling, yields going higher again, bond prices falling. We've just seen the ECB is quite prepared to keep raising interest rates. It's almost like they want to intensify the crisis because they love the drama. Christine Lagarde, that would be in keeping with her personality. And then over in the US, I think we're going to get a 25-point rate hike now, but there's still a chance we'll get 0. I don't think we're going to get 50. If we got 50 now, you'd know that the Federal Reserve really just wanted to crush the US economy and didn't care about the ramifications, because it would just use taxpayers' money to bail out its clubby friends and bankers. So, this is how it's unfolding. It's almost like, moral hazards are embraced by current governments around the world. So I believe all of this ends with a further unraveling of US equity prices, because the banking crises are not going away. If anything, they're getting worse. And if small banks start falling in Midwest USA, they're probably going to be allowed to fall. And when they fall, the penny will drop for investors at large and depositors at large around the country. And then they'll go, there's something wrong here. And I think all of that sentiment will amass onto US equities. So very big rally in US equities, but really what we've seen is monthly ranges on a daily basis over 4 or 5 days now, but overall still going sideways. After the rally in New York yesterday, we're near the top of the range, we're slightly breaking above it. Personally, I'm a seller of US equity futures right here, with relatively tight stops, because anything can happen in these markets, certainly. And there is the risk to my bearish scenario on equities is that we just enter one of these silly phases again, where everyone just assumes, well, if the governments are just going to backstop everything when anything goes wrong, again, moral hazard embraced, we just keep buying because we'll always be rescued by Big Brother. It really is 1984, but in a convoluted way to support. This is how people are perceiving it. I don't actually think that's the case. I think the equity market could fall 10, 20%, even 30% before you'd really have action that was all about the equity market. At the moment, central banks are going to remain focused on inflation and think through, I think a little bit egotistically, that they've somehow solved the banking crises, but I think there's going to be more of them. And I also think there's ongoing geopolitical pressures that could again weigh on market sentiment. And we still have interest rates going higher with still high inflation, and none of this is good for Main Street USA or Europe. So I think people are getting a little bit over optimistic here, but let's see how far they can get over optimistic for the sell opportunity, unless that caveat I just explained is actually what's going to continue to happen. I think it's happening in the moment, but it won't be continued. I hope that all makes sense, and I hope you have a great day. All the best, Clifford Bennett.